Most Canadians race to pay off their mortgage early, thinking it's the key to financial freedom. But what if that strategy is quietly costing you hundreds of thousands of dollars in lost growth? Some Canadians are building six-figure investment portfolios while still paying off their homes using a 100% legal strategy called the Smith Manoeuvre. And today, not only will I break it down step by step, but I've also invited Mo from Momentum Finance, who's actually using this strategy to share his real life experience, the challenges, and what he wishes he knew before starting. My name's Darren. I'm just a regular Canadian who used to think that it was too late to start investing. I was in my 50s with kids and a mortgage and retirement coming fast. I figured I'd missed my chance, but I started anyway, and now I'm proving every day that it's never too late to build wealth. So let's get into it. Here's how the Smith Manoeuvre actually works and why it's one of the smartest ways that Canadians are turning their mortgage into an investment tool. Back in the 1980s, financial planner Fraser Smith noticed something odd. Americans could deduct their mortgage interest, but Canadians couldn't. However, the tax code did allow Canadians to deduct interest if the loan was used to generate investment income. His idea was simple but powerful. What if we gradually shifted mortgage debt into investment debt? Same loan size, but now the interest becomes tax deductible. That's the Smith Manoeuvre, turning your biggest liability into a long-term wealth builder. Before we dive in, a quick reminder: about 80% of the people that are watching right now aren't subscribed. If that's you, hitting like, subscribe, and share helps push this content to more people who think they've missed their shot at building wealth, just like I did. It's free and it really helps the channel grow. Let's break this down step by step, because once you see how it works, it actually makes a lot of sense. You gotta get a readvanceable mortgage. This combines a regular mortgage with a line of credit or a HELOC. Each time you pay down part of your mortgage, that same amount becomes available to borrow again from the HELOC. Think of it like this: with a normal mortgage, every payment just disappears into the bank. With a readvanceable mortgage, those payments start working for you, because the principal that you've paid down becomes new investment capital. You don't need to change your monthly payment with the mortgage. Each payment you make is split between interest and principal. And of course, in the early years, most of your payment goes towards interest, while a smaller portion goes towards principal. That principal portion is what matters, because every time you pay some of your mortgage down, that same amount becomes available to borrow again through the HELOC. The moment that you've paid down some principal, your HELOC limit increases by the same amount. Instead of leaving it there unused, you can borrow it back and invest it. The goal is to keep your total debt roughly the same, but redirect part of it towards building wealth. You take that available HELOC room and invest it in income-producing assets like dividend ETFs or blue chip dividend stocks or a balanced all-in-one ETF. It needs to have the potential to generate income. That's what makes the HELOC interest tax deductible. Over time, you're building a portfolio that produces dividends and growth that accelerate your wealth building. Because you borrowed this money to invest and earn income, the CRA allows you to deduct the interest on that portion of your HELOC. That means at tax time, you can claim that interest and often receive a tax refund, money that would otherwise stay with the government. Many investors use that refund to reinvest or apply it to their mortgage to help the cycle build momentum faster. So in simple terms, you're paying your mortgage as usual, but now that same money is helping build an investment portfolio and creating tax advantages along the way. Now, on paper, the Smith Manoeuvre sounds almost too good to be true, and for some people, it really can be a powerful way to build wealth. But like any strategy that uses leverage, it does come with risks. So what's the good? Well, you're building a portfolio faster, your money is working for you, and you get a tax advantage along the way. What's the bad? You're borrowing to invest. So when markets drop, your investments can lose value, even though your HELOC debt stays the same. It also takes discipline. You have to keep investing through ups and downs and stay organized for tax time. All right, so now it's one thing for me to explain this on paper, but it's an entirely other thing to hear it from someone who actually is doing it. So joining me today is my friend Mo from Momentum Finance. Mo, thanks so much for being here. It's great to have you on the channel.
It's my pleasure, Darren. Thanks for having me here.
Can you tell our audience a little bit about yourself?
100%, yeah. So for those who may not know me, from Momentum Finance channel, have been investing in the market for approximately 8 years now. More seriously, about 2 years ago, I would say, I switched my entire household's portfolio to a much simpler style, and now we invest in a 3-fund portfolio.
And today we're talking about the Smith Maneuver specifically. So let's kind of go over this a little bit so we can have our audience have a little appreciation for what this is all about and who it might be good for. What made you decide to do this?
Yeah, I was fortunate, Darren, a few years ago, I came across a webinar that was offered by one of the Smith Manoeuvre certified kind of brokers, and they talked about what it is, who it is best suited for, and really that sparked my interest. So tried to do a lot more reading on it, got the book, Master Your Finances for Financial Freedom, Master Your Mortgage for Financial Freedom by Robinson Smith. Really eye-opener. Watched a few videos on that topic, and then really got interested, so much so that I decided that it was the time, and it was a good decision for us to make that switch and start the Smith Maneuver portfolio.
And of course, we're talking about your mortgage here. So the traditional way would be to pay your mortgage down, but in this case, that's not what we're doing. So in that vein, why this method as opposed to paying the mortgage down?
Yeah. So for me, I'm a numbers person, and really what made the difference was seeing some of the projections of what this method is capable of accomplishing. At the end of the day, if done right, if done over a longer period of time with diligence and kind of that comfort level that what you're getting yourself into, you end up having a larger net worth. So we are talking about 20, 30-year time frame. And at the end of the day, you've been able to convert your mortgage from a non-tax deductible debt to a tax-deductible debt, because you're essentially paying off your mortgage and converting it into a tax-deductible debt, which can have a lot of benefits from a taxation perspective.
I think the big question here, was there any hesitation before you started? And if so, what was holding you back, if there was anything at all?
I think there definitely was some of those hesitations, because at the time, to your earlier comment, Darren, we were on a traditional mortgage. So we had our mortgage. We were already in the middle of our existing mortgage with our financial institutions. And so when I decided that, it was the right call for us, I had to do some of those calculations. Would it make sense for us to break our mortgage, pay a penalty, and make that switch? And it's especially when you are at the point where you have to pay a penalty, it always makes it tougher. We ended up deciding that it was worth it. So we ended up paying the penalty, switching the mortgage, and starting it early on, because we didn't want to wait another 2 years before we kind of start with the process. The biggest, I think, reason for us to make that switch earlier on was seeing how this approach of implementing a Smith Maneuver could set us up for success over a longer period of time. Remember, with the traditional mortgage, as you pay down your mortgage, you're building a larger equity, but that equity is pretty much locked. You don't have access to it. Whereas with the Smith Maneuver, you have the option of actually tapping into it earlier on and starting to build a portfolio.
Yeah, no, that makes a lot of sense. I think probably one of the big questions at this point for some people will be is, did you actually talk to a financial advisor or an accountant before you set it up? And I say that because you did mention that you got the book, you did some research, but did you do anything like that?
Yeah, so definitely a lot of reading on my part, read the book, watched a lot of videos from Robinson Smith, who's actually, his father was the founder of this Smith Maneuver technique 40 years ago. So he's the right source to look into it. Also consulted a Smith Maneuver certified mortgage broker. 100% advise somebody, if you're ever going to pursue such a thing, make sure you go through a mortgage broker that is certified in this aspect. There's no cost to you, but they know the ropes, so they can guide you along the way. At the time, I didn't know actually that even Smith Maneuver, their website and their academy essentially offer Smith Maneuver certified accountants or financial persons, certified financial folks. I didn't know about that. So at the time, I didn't really consult them. I tried to do a lot of self-reading and implemented that way. But Recently, I was fortunate enough to have Robinson Smith on my channel and did an interview on that. And through that, I realized that they actually have Smith Manoeuvre certified accountants, Smith Manoeuvre certified professionals. So I might actually consider maybe at the year end, maybe at least for one time only, have a Smith Manoeuvre certified accountant maybe look into some of my numbers just to make sure I'm doing things accurately as I'm hoping I'm doing it all these years.
Right. Now, I think it's important to know, like, which lender did you go with and for, what reasons? Because this is a unique type of mortgage.
Yeah, so you're 100% right there. And for Smith Maneuver to work, you need what is known as a re-advanceable mortgage. That said, having a Smith Maneuver certified mortgage broker was beneficial because they know what those type of mortgages are out there. And then they brought to us a few options. The reason we went with the one that we selected and we went with the Scotiabank step mortgage was that at the time when we compared it to other options, like there was, I think, Manulife had their own products, I believe RBC and BMO and other banks, there are major banks that offered this one as well. We just tried to do the math, which one had a better rate and as well as the prepayment privileges, because at the end of the day, sometimes with the Smith Maneuver, your goal is to try to expedite the process, right? So for example, diverting some of the funds and tapping into it. So which one offered us the best at the time?
Yeah, I think that makes a lot of sense. I've definitely learned in my, time of investing that it comes down to math. And in this case, there's a significant amount of math that would go into it. So how easy or difficult was this to get set up and going?
The process itself was, I would say, fairly straightforward in the sense that with the mortgage broker and the banks, you go through the process, you follow through. And for us, we were just a matter of transitioning to this mortgage. Now, a key caveat here is that in order for somebody to be able to actually utilize and use the Smith Maneuver, they have to have a principal residence with at least 20% equity built up in it. That's crucial. Without that, you won't be able to actually pursue this option. Because that was the case, overall, the process was straightforward. But one funny fact that maybe I'll bring up is that the bankers don't know much about, they don't know anything, to be honest with you, Smith Maneuver, and like they're confused. So much so that when we were trying to sign the paperwork, with Smith Maneuver, you would get a home equity line of credit attached to your whole package of mortgage. And they were essentially saying, why are you trying to use your HELOC? That is, you understand that the rate on it is higher than your actual mortgage. And I was like, well, that's the whole point of it. Like we are trying to do. So if you're not equipped with the knowledge and you're not kind of accompanied with the right supporting system, there's a high chance that you might make the wrong decision. So we were so fortunate that actually we went through a certified person along the way.
Yeah. It sounds like they have a good foundation here to make this work. And I don't think it's very widely known. And the reason that I know about it is because I had watched your channel and I heard you talk about it. And like you said, you recently interviewed the owner of the company, is it?
Yeah, Robinson Smith. So he's I believe right now he's the CEO of the Robinson Smith Institute, and his father, Fraser Smith, was the founder of the Smith Maneuver 40 years ago.
Right. So obviously with this going on, the audience probably wants to know a little bit about what the numbers are like. And I know from my experience of watching your videos, you do keep a spreadsheet that you share on your channel when you do some of your portfolio updates and whatnot. But can you share a little bit about the numbers when it comes to this, like how it's performed, how often you're doing it, when you're not doing it?
100%. Yeah. So we did start our Smith Maneuver approximately December of 2021. That's when we actually started to switch our mortgage, start that. I have to do a little bit of math, but I believe it brings us to close to 3.5 to 4 years from since we kind of implemented it. And at the time that we started it, we had already built some equity in our home. With Smith Maneuver, there's one of the accelerators of it. They call it. I'm forgetting the term, but essentially, one of those accelerators that allows you to right off the bat use the equity that you have built in your portfolio and start that in your Smith Maneuver portfolio, because they're assuming that that's already something that you've already built up, so you can tap into it right away. So that was really helpful. What all of that meant was that our Smith Maneuver portfolio starting size was approximately that $60,000 as a starting point. But as part of that, Darren, not all of it was essentially like an amount that we borrowed from our home equity line of credit, because when you borrow from your home equity line of credit, that's a higher rate associated with that. So a lot of that 60,000 was part of that side, quote unquote, the mortgage side of it, which was a lower rate for us. It's still variable, but a lower rate. Fast forward in approximately, I would say now, we're talking about late 2025, business has grown tremendously. This is my Smith Manoeuvre portfolio, currently sitting at, as market is live, at 187,904,000. If I look at this, and this is showing since inception, so that's what I had in mind. So if you go back, to since inception time, the starting point value was close to 68,000. Sorry, my math may not be exactly correct, but that's 60,000 mark around that. So 68,000 to be exact. And
so that first initial investment was $68,000 with the equity that you currently had. Is that correct?
Exactly. So that was the starting point. And from there onwards, anything that you see from the growth perspective, so how it works is that two ways. One, as we paid down our mortgage, the equity portion of it becomes available for you through the home equity line of credit. For some banks, it may become available right away. With the Scotia step, it usually takes 1 or 2 cycles. So it's not right away, like the next day you can access it. Usually it's like the next 2 months, but as long as you plan ahead of it, because every month you're paying down your mortgage, so then you're going to have some money every month technically be able to tap into it and borrow it. But if it was just that, it wouldn't have gone to this level. What we've done, we've tried to actually expedite the process using some of the accelerators. For example, when we have some money sitting on the side, use that money, pay down our mortgage, use the prepayment privileges on our mortgage to pay down our mortgage faster. That portion becomes as an equity available after a few cycles, and then we borrowed that to make the account grow a lot faster. What we did there and here, maybe quickly if I mention in terms of what we have in this portfolio, at the beginning I was investing in VEQT. I wanted to keep things very simple, but then I don't know what hit me. I was decided that, let's just make things simple. Because I have XEQT across all the other accounts, so I decided to switch to XEQT, which if you're comfortable, maybe I'll quickly show it to the teams, to everybody here. I would probably bring to your attention the bottom one, because that's really, remember, when you buy and sell, because if I switched from VEQT to XEQT, that might have thrown things off a little bit, but this is what I have. So this is how many shares I have. This is how much it's grown in terms of unrealized gain as well as the return. Close to 40% plus since you call it December of 2021.
Right.
Yeah.
That's pretty significant. Wow.
Yeah. Not bad. I would say annualized, if you think about it, almost 10%, right? Less than 4 years, I would say. So
a very nice return for, like you say, for using money that's just sitting there. And interestingly, for my audience, from my perspective, if you've been following some of my videos, I talk about having gone to the Enriched Academy, and during my financial session with them, they were asking me some questions about why we were attacking our mortgage so quickly. For me, it was, I guess now a psychological thing. I wanted to pay the mortgage down, but as a result of it, the suggestion was to then invest that money in their RRSP and then get the return. And so when I thought about this, what you were doing, in my mind, it effectively is very similar to that, because had I have invested it, now that we could use it, we could leverage it, but we're effectively kind of doing the same thing. So if you're thinking about using some extra money, and of course, this isn't financial advice, but talk to a financial advisor. There are options, I guess, is what I'm saying. And there's Smith Manoeuvre is definitely one of them, or you can do what we're doing as a way to leverage that money, I guess, because if you're paying your mortgage down, like you said, Mo, it's just sitting there. It's not doing anything for you, the equity in your home.
That's a very good point. Darren. Consideration as well for folks is that if you're getting yourself into Smith Manoeuvre, you got to be ready and prepared to consider this as a long-term strategy. This is not a short-term strategy. If you're not comfortable enough seeing your portfolio value going down, if you are impatient, this could not be the right strategy for you. And I remember, Darren, first year, when we got in, and you would see probably from the stock chart. So if I go very higher up, at some point, look at here, we got almost to, let me go higher up a little bit. It was close to 78,000, and then it went down from 78 to 69. And you can imagine there were a little bit of the uncomfortable feelings, and this is probably the time we were still contributing, and it was going to, and 10,000 in that smaller 70,000 is more than 10-12%, right? So it was did we pick the worst time to actually put money and invest in this? Because that was a large chunk of money too. But it's funny how when you look back at it now, fast forward, it doesn't even matter, because you're looking at it for a longer term perspective. And this is a lot of times when we talk about ETF investors. Would it matter if you try to time the market? Sure, maybe, but it also comes with a lot of anxiety. How do you know if this is the right time or not?
It's funny you mention that, because I think one of the biggest lessons I've learned, we're going to sidestep a little bit from what we're talking about here today, but I think it's important. It's an important message for investors to realize, and you've demonstrated it with your graph there. When you're brand new starting out and you see that big dip one day, and it happens. When Trump got in, things got pretty gnarly. Our portfolio went down $30,000. I don't know about you, Mo, but I don't get to go to the corner store and just drop $30,000. That's a lot of money. But you're right. If you're looking at it through a very narrow lens, or you step back and look at it over time, it will make a lot of difference in what you do. In fact, just before we started recording, I had a little bit of money that's on auto deposit that goes into my account. And then I don't have it auto set up to purchase. I make the purchases. And one of the stocks that I was buying was VFV for the S&P 500. And in the last 2 or 3 days, it's gone up quite a bit in value. And I looked at the numbers. I don't usually look at them. And I thought, why am I buying this at this point? But at the end of the day, I have to stop and say, I'm buying it today. And I think it was valued at about $161 this morning. But if we zoom out, like you showed me on that graph, 2 years down the road, I'm going to look at that. It'll be a little blip and it won't make a
100%.
difference, because I think the term is markets are efficient. I think literature has demonstrated that they are efficient. So over time, this will grow.
100% agree with you. Very good points there, Darren. And at the end of the day, because we are, and I mean, a lot of times when we say that, people say, well, like when you say that you're long-term invested, but in reality, if markets drop or you see those huge market dips, you may not really actually stick to it. And I was reading a post, I think earlier on, Joe was talking about in one of his posts and commenting on somebody else. But I think self-awareness and self-realization is so important. It might, if somebody thinks that that's how they're going to react, then maybe rethink the strategy. Maybe this approach of investing, maybe being in full equity may not be the right decision for you. Doesn't mean that just because Darren and Mo maybe prefer this style, it's the right style for everybody. You got to know yourself, know your risk tolerance. And there, I don't know about you, Darren, but I believe both of us have been through some of those, like prime example, recent, with early in the year, and some of those, we've seen that. And as humans, we evolve too, right? It doesn't mean that because we've seen that we're always like, who knows, maybe 5 years down the road, I might change my style. I might not be even comfortable with that. But right now, this approach works for me.
I think you're hitting the nail on the head as far as risk tolerance goes. I think a lot of people think they know what their risk tolerance is. But the reality is that until they go through something like that, then they truly understand what their risk tolerance is. And it's important. Like, I think sometimes when I hear about financial advice that people are getting, or the way they talk about it, financial advice is not about selling you a product. It's about helping you with your mindset more than anything, how about guiding you through that process. And I think that's one of the things that I find about channels like yours and mine and other people that share their journeys is it should give you some realism, because we're being very genuine, like you just shared about how you saw your portfolio drop and you're asking yourself, is this the right thing to do? And if you can take something away from our conversations, it's this is going to happen. Are you ready? And how will you weather that over the long run?
100%. The psychology aspect of money is so important, Darren. You're right.
Well, and we're not talking about small amounts of money like your paycheck. We're talking about very large amounts. And, the compounding part is growing your portfolio more and more and more. And so the more money you have, the more those dips. When you talk about a 1% dip on a $20,000 portfolio versus $1 million portfolio, completely different numbers. So what's been the toughest part so far? The record keeping, the emotional side, or something completely different?
The toughest part, I would say, in the beginning days was just getting comfortable with the notion of seeing at the end of every month, you're getting charged with the interest. Because you're borrowing to invest. So you're going to see that. And also, we went through some of those higher interest rate environments. I would say for the most part, we're out of that for now. But interest rates were very, very higher. At some point, I believe we got closer to, in terms of variable rate, to that 7 to 8% mark, which is like, getting a little bit uncomfortable. But you have to remind yourself as well, you're doing it for long term. You are getting the tax refund at the year end. Again, this was a good reminder as well when I talked to Robinson. He was mentioning that in the higher interest rate environments, even though your equity portion of the returns that you're going to get is smaller. What I mean by that is that let's say when you pay $1,000 on your mortgage, because you have a higher borrowing rate, the principal portion is smaller and your interest portion is larger. That's true. But because your interest portion is larger, the amount quote unquote eligible to be getting a tax refund for it at the year end is going to be larger because you paid a higher interest rate, assuming you borrow to invest. That's also, of course, the notion behind it. So that's a good reminder. That was early days. Right now, I would say mostly, I wouldn't call it a lot of challenges, but mostly like trying to stick to it and not forgetting that continue. I think the diligence and continuing on the process is so important. So don't forget every single month as the equity is paid down, borrow no matter what, borrow and reinvest, and try to also accelerate the process, because you're going to get there a lot faster and you're going to see the results very, very faster over a long period of time, I would say.
That actually makes me think about the different types of markets. We've been in a really strong bull market for quite a while, at least since I started investing. And of course, there's a lot of talk about the fact that we're probably going to get into a bear market. Statistically speaking, I think it's something like every 8 to 9 years on the average, you hit a bear market. It wasn't one of my listed questions, but it makes me think. So how would this perform? Which market is it better to perform in? Because you mentioned how interest rates change and they're kind of tied to those different market styles and the economy.
Yeah. So, I mean, my suspicion would be on this one, Darren. And let's just go in my head. Sometimes I like to, and my wife hates it, but I say, what's the worst thing that can happen? And she's not a big fan. But really, that's how I try to a lot of times prepare myself. So let's say, for the sake of argument, this portfolio goes in half. Am I needing this portfolio right now? Am I in any point in time right now tapping into it and getting money out of it? Not really. Like, this is there. We're going to go through a few options, but that's not going to happen. That would happen, but if it happens, it's not going to bother me because it's not going to matter to me. The other comment and concern is that, okay, if that happens, are you able to still pay your interest on the borrowed amount from your home? Yes, because that's not going to change. I'm already doing that anyways. And I've already built in some buffer. With the Smith Maneuver, there is a way for you to, they call it capitalized interest. Essentially, as you pay down your mortgage and equity builds up, as the interest on your HELOC is charged to your checking account associated with that, you borrow back the borrow back the amount available in your home equity to pay back the interest portion of your interest. So in other words, you're not really using any cash from your own pocket to sustain this process. You just have to make sure there's enough built-in cushion within your HELOC. So don't zero out your HELOC. Otherwise, there's nothing left to be borrowed to pay down the interest on your checking account, right? So that's one thing. The only other thing that comes to my mind, honestly, at this point, is that some people say, aren't you worried that the bank may come and they say, your margin, because some people consider it as almost like a margin, right? Oh, now the value of your holdings have gone down. You might have to sell something to bring back. First of all, I don't think that's going to happen because your home equity line of credit is secured against your home. So unless there's a catastrophic event that suddenly your home is devalued so much, I don't see why the bank would care because they have your home possessed anyways. Yeah. And if anything, in the meantime, they're collecting interest on your borrowed money. So I don't see why a bank would come and do that. And if that was the case, I still have large enough portfolio on the side that, sure, the worst case, I have to sell at loss, but I don't see the possibility of all of them happening at the same time really being that high.
So what's one of the things that you wish you knew when you started that you when you look back or reflect?
I wish I knew, and I would definitely encourage somebody, if they're just starting out, probably could consider to consult a certified accountant. I feel like that would probably give you a lot more reassurance. I'm not suggesting that necessarily I did something wrong, but that's one of the reasons I want to make sure this tax season I consult somebody, because at least if there's anything that could be optimized or improved, I want to do that early on. We're still only 4 years into the process. There's a high chance that you might be audited throughout the process. So you want to make sure you do your documentation top notch. Ideally have a dedicated checking account for this purpose. For us, we didn't do that because, with Scotiabank, I didn't have that coordination with the bank. If you have a separate checking account, you have to pay a fee for it. Though I realize in hindsight, Carl, who's a blossomer, you could probably negotiate with the bank and get a checking account without a fee for that. I wish I knew that. I didn't do that. And anyway, that's where we are. So do your research, try to push for the various options, and as much as possible, have a very clear documentation process in place.
Yeah, you're actually bringing up a good point, which is one of the ways to build wealth is to make good decisions about all of your money. And I think if you talk to a lot of investors at some point, they're probably looking at changing banks or negotiating certain things and to help them use that money for their purposes instead of the banks. And I know I went through the same things. So do you think this strategy is for everyone or only certain types of investors?
I don't think it's for everybody. I think it's mostly if you have all of those pre-discussed option topics that we talked about, like requiring at least 20%, as well as like having your principals. Then even if that's the case, you have that, still it may not be the right decision for you if you are not, from a psychological perspective, ready for it. Because at the end of the day, it is a form of leverage. You are leveraging the money that is an equity in your home, and you're tapping into it to borrow. So you are paying that interest on the borrowed amount. It comes with certain comfort level. It may not be for everybody. You got to know yourself well. Are you comfortable with those ups and downs of the market? Are you comfortable following this process for a long period of time? You're talking at least, I would say, 10, 15, if not more years. If you are, then, and even then, it might be a good option, but you still have to do your due diligence and really see and assess it fully.
So if someone's watching and they're interested, but they're kind of on the fence, you mentioned talking to an accountant was one thing that you wish you had done in the beginning, or that would be a good step. What would be the first step for them if they were looking to get into this?
I definitely encourage them to get the book, Master Your Mortgage for Financial Freedom. You could buy it. You could also borrow it, like what I did. Like, I try to, as much as possible, if the book is available in library, and we were fortunate we had that, I borrowed the book. I read that. Excellent book. Fantastic book by Robinson Smith. Gives you a good sense of the whole strategy, and it might actually trigger some questions for you. And once that's the case, definitely encourage you to go to the source, because at the end of the day, if you're implementing a Smith Maneuver, probably you want to go to the source, smithman.ca. That's, you can get a lot of information. The next step that I think you could try to do, if you want to have a gauge of, hey, for those who have implemented it, what are some of their lessons learned and whatnot, maybe then you might want to consider watching some of those videos. Like interviews like this is fantastic, Darren. If folks haven't checked out my channel, I do have a playlist even on the Smith Maneuver. So I
was just going to say, I'll link it in the description for the website, but yeah, go check out Mo's channel. That's where I found out about it. So lots of good information on his channel there for sure.
Thanks, Darren.
All right, so Mo, thanks very much. It's been really awesome. Thanks for sharing your real experiences. It's one thing to explain this on paper, but it's way more powerful to hear it from someone who's actually doing it like yourself. Now, if you want to follow Mo's journey more closely, you should check out his channel. It's Momentum Finance. It'll be popping up on the screen here. He's got lots of great content on personal finance, investing, and of course, the Smith Maneuver. So you definitely want to go down there and subscribe. And of course, you can tell like here right on the screen, Mo and I are both on Blossom. And if you're not aware of Blossom Social, it's a great social investing app where I like to say, you're putting the pieces of the puzzle together. And this video is one of those pieces of that puzzle. So if you want to bring it together and talk with other people, great place to learn. Check us out on there. Give us a follow on Blossom. And yeah, thanks very much for joining me today, Mo.
It's been my pleasure. And Darren, you pointed out nicely, Blossom, right? That's how we connected. I wouldn't have known you if it was not for Blossom. So super honored that you invited me to this episode, and thanks for including me as part of this video.
The Smith Maneuver isn't a shortcut. It's a disciplined, long-term strategy that turns your mortgage into an opportunity to build wealth. Of course, you should always consult a professional advisor before making any financial decisions. If you want to see a few different portfolios that I came up with that might work for beginner investors, you should watch this video right here.